It's time for the Creative Real Estate Podcast, your source for out-of-the-box real estate investing strategies, brought to you by realbluespruce.com.
Welcome back to the Creative Real Estate Podcast. I'm your host, Adam A. Adams, and today we're actually in for a treat. We're going to be talking a little bit about Jens' path and what he's been doing, where he's going, and it's very interesting because he's done a lot. It's actually incredible. Just for you, I wanted to share a little bit here. It's Jens Nielsen, who is part of OpenDoorsInvesting.com. That's where you can find Jens, is OpenDoorsInvesting.com. And that's, if you want his email, it's JENS. That's Jens at OpenDoorsInvesting.com. And that's doors plural, right, Jens?
That's correct.
Okay. And then just wanted to share a couple of the very, very interesting things is he owns 70 different properties or doors directly, which is quite a bit if you are not syndicating to have those 70 doors. So very impressive. Not only that, but he's involved passively in a couple thousand mobile home units and a couple thousand storage units, 500 multifamily storage units. So he is diversified as all get out. Right now, he's really focused on Albuquerque, New Mexico. So his main goal is to do his first syndication. So he's looking at some larger portfolios. He's got a 107-unit property. He's got a 230-unit portfolio of, it's 2 properties, right?
The portfolio of the 107 is actually 2 property, and the other 230-some units are 3 properties that one seller owns.
Awesome. And you only got started doing real estate about 3 years ago.
That's correct. Yeah, I've been an IT professional for my whole life, and I suddenly one day realized that this path is a good income, but it's also a 9-to-5 job, and I needed to build some passive income and really try to get some freedom in my life. And then I thought that real estate investing would be the avenue that made most sense to me.
And you live in southern Colorado?
Yeah, I live in Durango, Colorado. It's kind of in the middle of nowhere, a small town, but if you like cycling, skiing, hiking, everything, it's just a great place. And but we're about 18,000 people in the whole county, so it's a small town. So meeting fellow investors and stuff like that is always a challenge around these parts.
So why do you want to invest in a spot that you don't live? So you're really focused on Albuquerque right now. Is that really close to Durango?
It's 3.5 hours drive south of here. So it's actually the closest bigger city. Denver is 6+ hours away. I used to live there, so I know the city well. I had a network, and I got in touch with some really good people when I started looking into investing. So it felt this kind of organically grew there. And there's some really interesting things happening in Albuquerque. For example, Netflix has just announced that they are going to move their North American production headquarters to Albuquerque. So that's a huge impact for the local economy. At least that's their plan. I think it's getting very close to that deal being signed. So I'm super excited about that.
Let me ask you why you decided to, you own 70 properties directly. What made you want to get into these, 4,500 other units passively?
So these are the passive investments through our retirement fund, me and my wife's retirement funds, and we felt that getting out of the overvalued stock market and get cash flow and long-term appreciation made sense. So we weren't too exposed to ups and downs in the equity markets. I've been through the 2000 crash in the NASDAQ and the 2008 global meltdown and all that. I was like, I don't want to do that again as I'm getting older. So we felt that diversifying, investing with some known operators would be a really good way to grow long-term wealth and get cash flow as we are working through that.
So what was your path to getting passively invested in those 2 big funds and also the 500 units of multifamily?
Listen to some podcasts and reached out to some people who were kind of syndicating and raising money for these deals. And I called up the gentleman who I heard on there, and I started talking to him, and I was like, this sounds really good. And just kind of felt that the deals they were operating made sense, and they had a lot of experience in the field. So I felt that, hey, this is a good way. So I set up a self-directed IRA, which, is kind of the way you need to do if you want to use your IRA money, self-directed IRA, and then started carving out money to various investments through that. So that includes a mobile home fund, a couple of different apartment complexes, a storage fund, and also some node, real estate node investing too. So kind of diversified throughout.
Incredible. Okay, well, what was it like when you wanted to set up a self-directed IRA? Did you have an employer, and was it difficult to move the money? What was it like for you?
These are monies that was just sitting in, a broker like Vanguard, and from prior 401ks that we had rolled over into just a regular IRA. So I just did some research on what the different companies were out there, what their fee structures were, and I found one that seemed to be, good reviews and reasonable fee structures, and I just set up the account and transferred the money over from Vanguard to this provider. And they don't operate like a traditional brokerage company. They don't make any money on commissions or sales charges. They just manage the funds for you. So they charge them a quarterly fee for the number of deals you're in and so forth. So it's very transparent. There's no conflict of interest there.
Okay, and the all three different things. So I mean, you've got multifamily, you have notes, you have, I think, storage units and mobile home parks, right?
Yes.
Okay. Are all of those the same one company that you're invested with, or did you have to meet like a mobile home expert, a note expert, a multifamily expert, etc.?
They are in different companies. The Node Fund was kind of the first one I started in, and that's one of the more well-known companies, and I started investing with them. And then the Apartments is with one operator who has that operates those properties. And then it was through the same person who got me into the apartment building. He is partnering with some other operators who got into the mobile home space and also the self-storage space. So it's just kind of through, this is all a relationship-based business, and I've met these people in person, and I feel like I can trust them and they know what they're doing. So that's kind of grown that network.
All right, we're back, and we're getting a lot of value today. Jens, thank you so much for coming on. Like I promised the listener, we have a couple of questions that I think are now it's your turn to kind of spill the beans. Tell us, the mastermind behind what you're doing that's going to get you to that next level. So what I want to know here is, you said you've already got 70 all by yourself. You've already got another 4,000 passively invested. Let me ask you this. Why do you want to be a syndicator?
There's a limit to how far I can go with my own money. Run out of money, and my thought is that by pulling other people together to buy bigger deals, you leverage, the ability to get on-site management, to get the economy of scale, and really go out there and take down these bigger deals that just in the long run will build more wealth and accumulate better returns. So that's kind of where I'm going for. Owning a 10 and a 15 and 20 unit building is great, but it does have some headaches with management, and I feel that the bigger properties will help a lot to eliminate some of those problems.
Great. Okay, so if you do syndicate your own deal, what do you see as being the risks associated with being the sponsor on a deal? And what are you doing to stop those, to mitigate?
The risk is, in the underwriting, and then the interest rate risk that we're probably facing. Obviously there's a lot of money out there now. So the prices have risen a lot in recent years. So, and there's probably that kind of idea of a lot of people heading towards this. So there's probably a lot of pressure to try to make something work, when you kind of back of your head, it's like, no, this doesn't really make sense. It may make sense now, but if interest rate rise or the economy has a downturn, you could find yourself in trouble. So do really good underwriting, and also try to get longer term financing. some of our deals that we've done ourselves, we've gotten 10-year terms on our loans, which I feel is mitigates some of that risk. So that's some of the things you want to do. And then obviously, who do you partner with in terms of who are the other sponsors you deal with, who is going to be property manager and your brokers and everything else. So just create a team that really has the experience and makes sense, and I'm preparing myself through this may be your next question, but I'm preparing myself through a member of a mentorship group where we have training and the various resources to help us with the underwriting. We get our training, we get our other partners and people we can kind of team up with and so forth. So that's a big group of people that really helps us with the building that team and getting the credibility behind us. So
excellent. Okay, great. So let's talk about the 107 and the 230. How much, what's the purchase price on something like that?
Yeah, so people may fall out of their chair when I say what the purchase price in the 107 is. It's actually $3 million, which is like $28,000 a door. This is an interesting property because it has a HUD loan on it, which is kind of the holy grail in financing because it's fully amortized. It's 35 years amortization, fixed rate for the full term, assumable loan. So once you can get through the hurdles of taking over a loan like that, you don't have a risk on your financing through the full term. It does have some income restrictions, so it does cater to a certain lower income tenants, but we feel that my partner who is in Albuquerque, he's done a lot of those types of deals and manages thousands of units there. So we feel like that's a very strong, he has a very strong management in that area. So that would really fit into the model there.
Mm-hmm. And how about the 230?
230 is it's a set of properties that was built in the 70s, and the current owner, I think it was his dad who built them, so they own it free and clear. They have run extremely high expense ratios. We looked at the P&L, is like 70-80% ratio, so we feel there's a lot of room for improvement there. There's probably, we try to look at value add deals because there has to be a little bit of a play in the value add, otherwise it probably doesn't make sense to buy a lot of these deals right now. So we find that people are just kind of putting money into them, but not enough to really raise the rents and keep the property maintained. Especially this one deal we bought in the spring is a 36 unit, and it was those people who bought it just been bleeding money and just didn't have the money to maintain it, so the roof was leaking and a lot of problems. So we took it over and has been into gutting it and really fixing it up. So that's kind of, we try to focus on these kind of hairier deals, if you will, that need a lot of work to kind of get up to their potential.
I have a couple more questions on the 230. You said that there was a 70 to 80% expense ratio.
Yeah.
And by the way, for the listener, that's very, very, very high. In my experience, if $1 million is coming in around 500,000, anywhere from 450 to maybe 550 should probably be going out in expenses. But in this case, you're probably at $750,000 based on that number going toward the expenses. So I have a couple of follow-up questions. What is the occupancy rate? The first thing that I would guess is that it had a really low occupancy.
It's in, I think it's 80-85%. So it's not terrible. I think one of the properties, they actually kind of kicked out all the tenants and started re-leasing it. I'm not sure if that was because they had poor tenants in there or whatever. So that unit, I think, is only 60 to 70. The other two are in the 80-85. And I think we talked to some agency lenders, and they said they would be able to do a loan and give 85% occupancy. So that's pretty good. But yeah, so they have not been very aggressive at trying to keep it leased up. So that was one problem. I think one of the other problems are, it's hard to read through a P&L and see where's the money getting siphoned off, because there's salaries, there are maintenance people, there are all these things. But we kind of look through and say, why is there a $30,000 annual pool fee and a couple $100,000 worth of salaries for leasing agents and maintenance people and so forth. So there could be some stuff being padded there and money, kind of exiting the property in other ways. We're not sure, but from an NOI standpoint, it's pretty poor right now.
All right, I have a lot of questions on this 230. All right, so the next one that I was going to ask is what year it was built.
I believe it was like in the mid 70s. That was that's about the time frame. Yeah.
All right. And how many different properties did you say made up 230 units?
3.
Okay. And the pool fee at $30K, is there a rule of thumb that shows what it should cost for the swimming pool annually?
I'm not too familiar because none of my other properties have swimming pools, so I actually don't know. And this was just an example of one of the expenses that seemed a little outrageous, and also a lot of repairs and maintenance costs and so forth. Just, I guess my point was, it seemed like the expenses were padded in many areas, or way too high. Maybe they've had the same pool guy for 20 years and he just kept raising the rates and they've not been competitive in trying to find new bids and so forth. So.
And you said a couple $100,000 for the leasing agents. Is that right?
Leasing agent and on-site management. On-site management, including a leasing agent, and then on-site maintenance people. And I think there was like an assistant leasing agent too, and then some other fees for contracting services. So it all added up to very high numbers.
What's the purchase price again?
So this one is kind of a off-market deal, and we were looking at offering low 3 million, 3.2, 3.3. I don't know that the seller was quite that motivated yet, so we are still kind of going back and forth on it. Again, this is my partner is down there. He does own a management company and is also a broker, and luckily partners in deals too. So he's kind of still working through the numbers and trying to get to an agreement on that.
So is there a plan currently in place on what you would do with the management company?
Yeah, so we would basically, get rid of the existing management that's in there, and then put in, through my partner's company, put in on-site management to manage these 3 properties. They're like pretty much next to each other. Put probably one leasing agent in that would manage all 3 properties, and have 1 or 2 maintenance staff there. Again, due to scale, my partner owns and manages other properties in that neighborhood, so he could have one leasing agent that could run 5 or 6 properties, and they would all be within a 2 blocks radius. That would be really helpful.
Yeah. What's the biggest one thing, like, you've been in real estate and done quite a bit in the last 3 years? What's the biggest thing you've learned?
Biggest thing I've learned. I've learned to negotiate with people, as sellers. You gotta, even though if you, because I've dealt with some off-market deals through my direct mail and stuff like that, even though you try to approach it very by the numbers and professionally, people get very emotionally attached to their properties. Let's say this guy's had his 20 unit for 10 years and this is his life. And then you come in and say, well, the roof doesn't look so good and it needs to be updated, so I can only pay you this. And a lot of people actually I've found, don't take that too well. So I think building rapport, really getting to know people before you talk business, I think is something that I have learned. It's important.
I love it. Thank you for sharing that. That's really good insight. And we're ready for the final 5. Are you ready for the final 5?
Absolutely.
Great. Well, question number 1 is, what's the most creative deal you've ever done?
So there was a smaller. This was 11 units. It was a seller finance deal, and they wanted a certain price for it, and we realized, this needs a lot of work. So he seller financed it, but we did not pay anything for the first 11 months. I think 10 months. We did not pay any interest or amortized any payments on the loan. So all the cash flow in the first 10 months we put straight back into the property. So that meant that we could come up with less cash to start with. So we had the $5,000-$6,000 a month we could just pour back into rehab the unit. So that was a really good deal.
Let me ask you a question on that. You mentioned how you didn't have to come out with too much upfront, and you were able to use the cash flow. If you went into the same situation, what would you prefer, to raise more upfront or to do the same thing you did on that one?
You got to be very careful about trying to do rehabs through your cash flow, because you are looking at a long period of time but you won't make any money, So ideally, you would bring in the money up front to do the rehab and try not to rely on the cash flow, because your returns is going to be so inconsistent. So if I, at that time, if I'd had another $100,000, that would have probably just put that in right away.
Okay, I love it. Thank you for sharing that. What is a book that you recommend to the listener?
The One Thing by Gary Keller. Yeah.
Well, tell us why.
Oh, it's really the idea of focusing and getting the most important thing done in the morning, every day. So basically just, hey, what do I need to do so everything else becomes unimportant, So that's really, and I think we are so used to so-called multitasking, where you try to work on 5 different things at the same time and you don't do any of them well. So just focusing and really getting one thing done, that makes a lot of sense to me. I try to practice that.
Thanks. And you got started 3 years ago from the time of recording. Where were you 5 years ago? Kind of paint us that picture. What did it look like for you, Jens, when you were back in 2013, 2014? You were about to get started in multifamily. What did that look like?
Just working as an IT person, in Durango, enjoying, biking, hiking, skiing, and all that stuff, and not really worrying too much about how many more years I would have to work my corporate job in order to retire. So and this, I don't know if this is a background or limiting belief, but growing up I'm from Denmark originally, and it's just not the same mentality of entrepreneurship and stuff like that the US has. So I was just perfectly happy just being an employee. And, but then I suddenly realized, hey, that ain't going to work in the long run. So.
Okay. Got it. Thank you. Well, what about 5 years from now? Where do you see yourself?
I will not be working here any longer. I'll be a general partner in multiple syndications, and I will be, living just a life of a little bit more purpose and having time to, explore my passions for travel and outdoor activities and so forth, but also, creating good returns for investors and continue to build a real estate portfolio.
How do you give back?
I donate to various charities. I do some coaching, I have a few coaching students. I, again, keep getting back to my outdoor activities. I help with, trail work and outdoor type, just keeping up with the local community and so forth. So. And
if anybody wants to reach out to you, it's Jens Nielsen, Nielsen, and you can find him at opendorsinvesting.com. Yeah, you need to put that S on the door. And then, or just go to Jens, that's spelled Jens, at OpenDoors investing.com. So definitely reach out to him, and thank you for coming on. And until next time, my friend, think outside the box.